15 e-commerce sites that aren't Amazon you should invest in. The ever-growing trend of e-commerce is impacting how people shop. Many people now rely on the internet to buy their favorite products. Online shopping offers a wide variety of items. You can find whatever you need from the comfort of your own home. COVID-19 has allowed e-commerce to reach new heights as customers are less concerned with the threat of being face-to-face with a dangerous virus. Even as the pandemic comes to an end, there's still high demand for e-commerce. For today's video exclusive for our Fortune Fastlane members, we'll be talking about the different e-commerce sites that you should have invested in if you still haven't. If you're one with an interest in granting an investment opportunity in the internet retail industry, take a closer look at what these companies do and how their stocks have historically performed. Keep in mind that positive past performance does not guarantee the future success of stocks. We've rounded up the best e-commerce stocks to buy today so that you can benefit from growth in this sector. So without further ado, let's get into the video. First on our list is eBay. eBay is one of the largest e-commerce platforms in America. It facilitates sales between businesses and consumers from all over the country. The online auction giant eBay has allowed people to trade goods with one another when they can't make it to stores. In addition to this, they're urging consumers to share in the responsibility of maintaining an economy. eBay contains a marketplace for products where consumers can buy, purchase, and bid on. You can find anything you need on eBay. You can use this site to buy niche products such as Bluetooth motorcycle helmets, or for something more general, the best gaming mouse for your needs. Its P2P model is very different from Amazon and other more traditional retailers. eBay has been consistently growing this year with a relatively low PE. It's possible they could be slightly undervalued right now. However, the company announced plans to buy back $5 billion in shares this year. This could help keep the company's stock price stable. This is an attractive e-commerce pick to watch moving forward. Etsy is another peer-to-peer e-commerce company that allows members to set up their own shops to sell handmade and vintage items. Etsy has been doing relatively well over the past year. Part of Etsy's appeal is its selection of unique items that consumers can't find anywhere else. This company has a loyal customer base, with 60% of their sales coming from repeat buyers in 2018. What is the most notable clothing resale app here? Although there are many, one good example is Depop. Etsy is one of the few sites where you can buy handmade and vintage products, which set them apart from other big names in e-commerce. This stock has delivered excellent returns over the last year, which appears to be just the beginning. Chewy, an e-commerce retailer that specializes in pet products, is popular with pet owners. If you have a pet, then Chewy is the product for you. You can search by brand and select whether or not to have your purchase delivered monthly or provide a one-time purchase. With a whopping 57% increase in shares, Chewy is back on its feet and looking toward a promising future. Their stock dipped in March, but since then has regained considerable ground. The company is experiencing steady growth year over year. Chewy became profitable for the first time at the end of 2020. The company did have some losses in the first half of 2021. However, analysts expect the company to soon reach a point where profits are equivalent to expenses. Chewy has found a unique way of doing business in the e-commerce marketplace, and it appears they will grow even more in the future. These factors make Chewy an exciting investment opportunity. With sales of nearly $520 billion in 2020, Walmart is the largest American retail corporation. The coronavirus pandemic caused people to switch to online purchases. They felt more safe because they could buy items without going into the store and being exposed to microbes. Walmart was able to switch over to e-commerce during the pandemic, even without exiting any other markets. They also offered a curbside pickup service to increase customer involvement. While one of their stocks dropped off a bit in March, it has since recovered well and is on an upward trajectory now. Walmart is a stable stock, especially in times of economic downturns. It focuses on basics like neckties and other essential items. They also offer a 1.49% dividend yield, which is certainly enticing to income investors. And in our sixth spot is Target. Target is one of the largest retail chains in the US. While they are widely known for their in-store offerings, many of the company's e-commerce methods have been developing for a few years now. Target now offers a robust online shopping experience, which includes being able to order delivery or pick up items at a local Target store. Target has made a name for themselves as they provide quality items. They offer a variety of high-quality and sustainable products at a relatively affordable price. The company is constantly innovating with its business model to offer the best experience to customers. For example, they have been opening small format stores in urban locations for better accessibility. In the past year, Target stock has increased and is giving well-invested customers very good returns. This stock provides 1.45% dividend yield in addition to its ongoing success. Overall, Target has proven itself to be a reliable portfolio addition. Another one is a Canadian-based platform called Shopify. Shopify helps small businesses sell goods online. Unlike other platforms, Shopify does not require steep upfront costs or monthly fees, and you're free to change the kinds of goods you sell at any time. This platform offers a wide variety of e-commerce tools and integrations. These include product listings, payment processing, email marketing, and more. Shopify stock is still expensive and overvalued. This has been shown through evidence, but this may be disputed by some investors. However, this stock can be a great investment as you could make significant profit from it. 43% of Shopify shares are bought in the last year, and with a steady increase whilst other companies have tanked. Despite restrictions on the pandemic, the company saw increased revenues and user growth in the second quarter of this year. Many analysts expect this growth to continue. In times of economic turmoil, home prices rise and with them, home improvement stocks such as Home Depot. A surging housing market have made Home Depot one of the strongest performers in the retail sector. 27% of sales come from online shopping, and this is expected to grow. Home Depot is still an attractive stock because the sector has promising prospects in the coming years. Home Depot's investors are urged to be more patient as the company realizes lower sales growth in the near term, but analysts predict that this will turn around soon. Bank of America has a buy rating and a $391 price target for HD stock. Aside from the retail stocks, we also have e-commerce payment stocks. One of them is PayPal. PayPal is an online payment processing service that allows users to send and receive money. PayPal has become a popular payment option for online businesses of all sizes. Many consumers prefer it because you can pay online without giving individual businesses your credit card information. In addition, PayPal has their own services and also owns Venmo, which is a popular payment app. They've also recently launched Zelle, which is a point-of-sale system for small businesses. The stock has increased this year, and that does not come as a surprise because we have seen positive figures from their finances. They have seen steady revenue and earnings growth over the past 5 years. PayPal is currently the world's leading online payment processing system. Given the recent success of their campaigns, it doesn't seem likely to change anytime soon. The company does offer some e-commerce tools as well. Another example of an e-commerce payment stock is Square. Square is a financial service and mobile payment platform. The platform is run by the founders of Twitter, who are based in San Francisco. Yet, despite the differences in their services and approaches, PayPal and Square are often seen as direct competitors. Businesses can manage their inventory and sales with Square's suite of tools. These include a popular point-of-sale system that is designed especially for brick-and-mortar store locations. Square owns the Cash App, a popular peer-to-peer payment system with some e-commerce features. Square's revenue was up in the second quarter of 2021 and is expected to do well for the rest of the year. Furthermore, Bitcoin sales have helped boost in the company's revenue. The company will be acquiring more companies to expand their business. So far this year, Square has delivered huge returns. Other than that, they are one of the top e-commerce and fintech stocks to keep an eye on this year. We also have one of the best Chinese e-commerce stocks, which is the Alibaba Group Holding Limited. The company has been called the e-commerce company of the East and is based in China. Baba stock has been discussed heavily in the media this year. After the company peaked in October, their stock has been gradually going down. Much of this is due to the Chinese regulatory boards investigating the business. The absence of Alibaba's co-founder Jack Ma and his public appearance is part of a major factor in the company's recent struggles. Alibaba has grown to become a huge player in the world of Chinese business, generating huge revenue numbers and making it essential for China's economy. This e-commerce stock is one of the riskiest seen in the markets today, so it may not be the best choice for everyone. However, it's possible that Alibaba could bounce back from these setbacks considering they have a large market share in China. This may be a great time to invest when shares are down. Pinduoduo is the second largest Chinese e-commerce platform by active buyers. In the near term, Pinduoduo and other Chinese tech stocks face risks that Joyce Ju says are due to regulation. But in the long term, Ju is most bullish on the growth of e-commerce and that it's a better trend for Pinduoduo investors. Ju says that Pinduoduo's exposure to smaller Chinese cities is a significant differentiator when compared to Alibaba and JD.com. With a team purchase model and a social media presence, Pinduoduo's sales have nearly doubled in 2020, which outstrips growth rates of both Alibaba and JD.com. The Bank of America has given a buy rating and has also set a $143 price target for the company's stock. JD.com is another e-commerce company based in Beijing, China. JD.com's biggest competitor is Alibaba. That being said, JD.com controls just 17% of the market share in China, while Alibaba holds as much as 59% of the market. Walmart has a 12% stake in the company, and though e-commerce only represents 3% of its retail business, Walmart is betting on China as the future of this market. This stock peaked in February but has dropped off since then. It's only in August that the company shows a hint of upward momentum. When it comes to stocks, JD.com is one of the best options on this list. It's traded at a low price and has steady financials. Now, it might be a good time to buy the dip, but consider the risk before investing in Chinese companies. In the first half of 2022, many stocks in the e-commerce sector slid because they were either overvalued or did not have enough profits. In addition, a rising interest rates and inflation may have minimized the appetite for such stocks. One e-commerce stock that has this positive quality is Revolve Group, whose trailing net margin is 39.7% and trading at a reasonable valuation of 19 times forward earnings. Revolve Group is a company that sells apparel, accessories, and luxury goods to millennials and Generation Z. Revolve Group uses algorithms and data analytics to analyze social media and their proprietary technology to forecast emerging trends and manage inventory. Revolve makes partnerships with influencers on social media and features collections curated by them. The data-driven approach of Revolve seems to be working. It's not common for a retailer to be able to sell their products at full price, and this company has been able to do that in 87% of the time in 2021. Revolve also boasted gross margins of 55% in 2021. Revolve increased both net sales and adjusted EBITDA by 35% in the first quarter of 2022, proving the company is a compelling buy now and hold for the future. Revolve has experienced growth on all fronts. Total orders, average order value, and number of active customers are all increasing. The name GoDaddy may not immediately jump out to you as e-commerce in the same way that Etsy or Amazon does because consumers aren't going to GoDaddy's website to buy products. GoDaddy is a company that provides services for individuals and businesses that are related to the creation of websites. By offering hosting, domain registration, email server, web analytics, and more, GoDaddy helps to make one's online presence easier to manage or grow. GoDaddy has a wide variety of services such as hosting and domain registration for small to large businesses. Since Ayman Botani became CEO, he has successfully expanded the company by diversifying its services. Adding new services such as invoicing and payments brings GoDaddy into some additional lucrative markets, and previously integrated services such as hosting are complemented by the new solutions. It makes a lot of sense for an entrepreneur or e-commerce that is already using GoDaddy to also incorporate its new payment and invoicing solutions. The company has done well by focusing on a diverse set of services from e-commerce, logistics, and entertainment. They have rapidly increased the gross monthly merchandise volume to $24 billion and increased revenue and EBITDA by 11% and 18% respectively in the last quarter. The company is aggressively repurchasing shares of its stock to build value for shareholders. In February, the company authorized a new share buyback plan for $3 billion, part of a multi-year plan to do so. GoDaddy is becoming a one-stop shop for e-commerce focused on increasing shareholder value. This makes it an ideal stock to buy for the long run. The last top e-commerce stock to buy is MercadoLibre. MercadoLibre is a This perennial growth machine has given investors a return of 860% over the past 10 years. The decline in price between now and 2022 would not have been as high if it didn't take into account MercadoLibre's 46% loss this year. If you regret missing out on MercadoLibre, after their decline, shares are now trading at a price point they haven't been at since the depth of the COVID-19 pandemic, more than 2 years ago. Now might be a good time to take advantage. The share price is on the decline, but the performance of MercadoLibre's business is actually stronger than ever. The market sell-off has caused a misunderstanding because Argentine company has grown revenue by 63% year over year. What is even more impressive is that it's not like the company has grown slowly or had a very low baseline to start with in the first quarter of 2021. Revenue increased by over 160% during this time. Although MercadoLibre doesn't make much money or have a high price-to-earnings ratio, it needs this to invest in infrastructure and its overall expansion. On a price-to-sales basis, the company is worth less than 5 times sales, which is low for a company that is growing as quickly as this one. Some leading e-commerce companies have seen a sharp decline in share prices this year. But even with the decline, these companies look very successful thanks to their robust underlying business models and reasonable valuations. Over the next few years, owning an e-commerce company is predicted to grow and continue to be of interest. Companies such as Amazon are predicted to grow with the trends and have plenty of time ahead of them. Now is a great time to buy into e-commerce stocks. Consumers have grown accustomed to convenience of being able to buy their favorite products online. This situation doesn't seem to be changing, even though the pandemic will end. Delivery service may soon be considered an essential kind of service rather than a helpful kind of convenience. More and more small businesses are choosing to sell their products online because it's cheaper and easier than spending money on the overhead required to operate a physical store. The new trend of e-commerce services means that investing in such companies is, for example, a great way to get profited. Some of the world's largest companies right now are e-commerce companies. These stocks are popular and have a great year because there is high demand for their services. These stocks likely won't slow down anytime soon. Increasingly, consumers are using online platforms and mobile devices. These changes are giving a boost to e-commerce stocks, making it a great time to invest. There you have our Fortune Fastlane video for today. Don't forget to subscribe to our channel, click the notification bell, and like this video. If you think that we have delivered value, please share this video with one person. Just one share is enough for you to show your appreciation for the commitment and hard work we all put together in creating this video that teaches and helps you on your mission of building your own fortune. And you don't know that one share could go a long way. And keep in mind that no matter how many times you're going to watch this video, you won't see any results unless you take action. Goodbye and see you at the next one.